Welcome to U.S. Tax Classroom. Every tax return has this one magical moment where your taxable income just drops. And for the vast majority of Americans, that exact moment is the standard deduction. So, what is it? Put simply, the standard deduction is an incredibly powerful, flat dollar amount that gets subtracted directly from your adjusted gross income, or AGI. And connecting this back to the three-step income calculation we covered in Miniseries 2, it sits perfectly at that final step before the actual tax calculation happens. The absolute best part about all of this, there is zero documentation required. None. You don't need to hoard a shoebox full of receipts, you don't have to painstakingly track every single medical bill, and you certainly don't have to prove anything to the IRS. You just take this flat, automatic reduction, and it instantly drops your taxable income.
Now, to make sure you fully grasp this, we are going to walk through 6 key areas today. First, we will cover what the standard deduction actually is. Then we will look at the 2025 filing status amounts. From there, we will explore the extra amounts for seniors, the brand new Senior Bonus Deduction, the tricky rules for dependents, and finally, some key exceptions. We are going to use a building block methodology throughout this explainer so you can see exactly how the math works in the real world. We will map out precisely how different income types and demographic factors impact your final tax bill.
Let's bring back a familiar face and introduce Sarah. She's a single filer from our previous examples. Her adjusted gross income is $57,500. Her standard deduction is $15,750. So let's subtract that. What does that come to? $41,750. This flat reduction protects over $15,000 of her hard-earned money from being taxed at all. That means before the IRS even glances at her tax brackets or applies any rates, Sarah's final taxable income is securely knocked down to $41,750.
Now, those baseline numbers aren't one-size-fits-all. They change depending on how you file. Let's go through the 2025 standard deduction base amounts for every single filing status one at a time. For single filers, it is $15,750. For married filing separately, it is also $15,750. Now, for head of household, we see a nice jump up to $23,625. For married filing jointly, it increases significantly to $31,500. And finally, for a qualifying surviving spouse, it is also $31,500. It is worth noting that these amounts all increased from last year. These bumps are built in to help offset inflation, ultimately dropping the taxable income for most everyday Americans.
Did you catch that detail about the joint filers? Notice how the married filing jointly amount is exactly double the single amount. That is completely intentional, designed to avoid penalizing couples who combine their finances. To see this in action, let's introduce David and Sarah. They are a married couple filing jointly. Their combined adjusted gross income is $75,000. Their standard deduction is $31,500. So let's run those numbers. What does that come to?
$43,500. This standard deduction protects a massive, significant chunk of their combined money from the IRS. It is a huge shield, leaving their final taxable income sitting at just $43,500.
But the savings don't necessarily stop at the base amounts. On top of those, certain taxpayers get additional standard deductions to help with the unique costs of aging or disability. Specifically, I'm talking about folks who are age 65 or older, or those who are legally blind. Let's introduce Robert. He is single and 68 years old. His base deduction is $15,750. His additional amount for his age is $2,000. So let's add those together.
$17,750. By stacking that age modifier, he gets a noticeably larger overall deduction. This provides an absolutely crucial buffer for taxpayers like Robert who might be transitioning onto a fixed income, giving him a final taxable income that is much lower than it would be otherwise.
Okay, let's move along and see how this builds for married couples. Let's introduce George and Martha. They are a married couple filing jointly, and they are both 70 years old. Their base deduction is $31,500. George's additional amount is $1,600. Martha's additional amount is also $1,600. So let's add those together.
$34,700. Their final taxable income drops by this entire combined amount. Now, shifting gears for a moment, let's introduce a slightly different scenario where George is also legally blind. Their base standard deduction remains $31,500. George's combined extra amount is now $3,200. Martha's extra amount stays at $1,600. So let's add those together.
$36,300. This brilliantly illustrates how these modifiers systematically stack together to heavily protect their money. Each qualifying condition adds another permanent layer of tax-free income, vastly reducing their final taxable income. Now, I need you to pay close attention to this next part. I cannot overstate this. This is one of the most significant tax changes for seniors in recent years. Starting in 2025 and running through 2028, there is a brand new Senior Bonus Deduction of $6,000 per qualifying individual. This absolutely stacks on top of everything we just talked about, and incredibly, it can be claimed even when you are itemizing your deductions, which makes it totally unique in the tax code. It does have a phase-out starting at $75,000 in income for single filers, but for those under that limit, it is a total game changer.
Let's see this in action and bring back Robert for his full calculation. Robert is our single, 68-year-old filer. His adjusted gross income is $60,000. His base deduction is $15,750. His regular senior deduction is $2,000. His new senior bonus is $6,000. So let's add those deductions together.
$23,750. This massive, stacked deduction of almost $24,000 is incredibly powerful. It means his final taxable income drops all the way down to just $36,250. This bonus provides incredible relief and effectively shields a huge portion of his livelihood from federal income tax.
Now we need to look at what happens if someone can claim you as a dependent because the calculation changes entirely. For a dependent, the standard deduction is the greater of $1,350 or their earned income plus $450, capped at the regular standard deduction limit of $15,750. I need to state this clearly because it is a critical trap. Only earned income, like wages from a job, increases the standard deduction. Unearned income, like interest or dividends, does not increase your standard deduction one bit. Yet unearned income absolutely still counts as taxable income.
Let's walk through 4 scenarios to show exactly how this catches people off guard. First, let's introduce Emma for scenario 1. She is a 19-year-old dependent college student. Her earned income is $4,000. Her unearned income is $0. Her standard deduction becomes $4,450. So let's subtract that deduction from her income. What does that come to?
$0. Because her standard deduction of $4,450 fully absorbs her wages, she doesn't owe a dime on this income. Her final taxable income is simply $0. Now let's look at scenario 2. Emma still has her part-time job, but now she has a small savings account too. Her earned wages are $4,000. Her unearned interest is $800. Her standard deduction stays completely locked at $4,450. So let's subtract that deduction from her $4,800 total income. What does that come to?
$350. Because the unearned interest didn't increase her deduction at all, she is left with a final taxable income of $350. That unearned income pushed her right over her protective shield.
Let's move to scenario 3. In this case, Emma has no job whatsoever, but she has a small brokerage account. Her earned income is $0. Her unearned dividends are $800. Her standard deduction is the absolute minimum, which is $1,350. So let's subtract that deduction from her income. What does that come to?
$0. Her unearned dividends fall safely under that minimum dependent deduction, so keeping her protected, her final taxable income is completely zeroed out at $0.
Finally, let's look at scenario 4. Emma still has no job, but her investment account performed much better this year. Her earned income is $0. Her unearned dividends are $2,000. Her standard deduction stays at the minimum $1,350. So let's subtract that deduction from her income. What does that come to?
$650. Wow. I mean, honestly, it is so surprising that an investment account generates a tax bill for her when she hasn't worked a single job all year, because that unearned income does not lift her deduction one bit. She is left with a shocking final taxable income of $650. This is exactly how the dependent trap catches young investors completely by surprise.
Now, as a final note, we have to mention who actually cannot claim the standard deduction. This includes non-resident aliens and people caught in the married filing separately trap. That trap is where, if one spouse itemizes their deductions, the other spouse is legally forced to also itemize and completely loses their standard deduction, even if it hurts them mathematically.
For everyone else, it comes down to a fundamental choice. Take the standard flat deduction or tally up your expenses and itemize. Will itemizing uncover more hidden savings for you? Find out in Part 2 of this explainer. Remember to subscribe to U.S. Tax Classroom so you don't miss it, and make sure to check our community post section for regular quiz questions to test your tax knowledge.